Last Tuesday, a woman opened her banking app to transfer money into her savings account. Before she could get to the transfer screen, a pop-up appeared. Friendly font, clean design. A simple message. We'd like to help you get the most out of your account. Please take a moment to update your annual income. Her previous income was pre-filled in the box. All she had to do was change the number and tap confirm. It would take 11 seconds. She did it without thinking. She had no idea that those 11 seconds would trigger a classification algorithm that would quietly reprice her relationship with that bank, not in her favor, in theirs. 3 weeks later, her inbox started filling with offers for premium credit cards with $495 annual fees. Her credit card app began showing persistent banners for personal loan products. Her relationship manager called unprompted to discuss investment services she had never expressed interest in. Nothing dramatic happened. Nothing she could point to as obviously wrong. Just a slow, invisible shift in how the bank was treating her. All of it triggered by 11 seconds and one updated number. My name is Williams, and what I want to talk about today is one of the most consistently misunderstood dynamics in personal finance: the income update request. That friendly pop-up that appears in your banking app, your credit card portal, your loan servicing platform. The form that looks routine and feels expected and carries the quiet implication that updating it is simply what responsible account holders do. It is not a service. It is a data collection event. And the data it collects will be used to make decisions about your financial life that benefit the institution collecting it, not you. Today, I'm going to show you exactly what banks do with your income information, why they want it updated so persistently, and what you are and are not actually required to provide. Before anything else, one fact that most people do not know and that changes the entire conversation. Banks are not legally required to have your income information on file for most financial products. There is no federal regulation mandating that your credit card company know your current salary. There is no law requiring your bank to maintain updated income data on existing accounts. The periodic income update requests you receive are not compliance requirements. They are data acquisition campaigns designed to look like administrative housekeeping. This distinction matters more than it might seem. When something is legally required, you provide it and move on. When something is requested, you have options. Banks deliberately blur the line between these two categories because customers who understand the difference make choices that reduce bank profitability. The request is framed as standard. The form creates implied obligation. The pre-filled field makes compliance feel like the natural completion of something already started. All of it is designed to produce a specific behavior, the behavior of handing over a number the bank does not need but very much wants. Understanding what they do with that number once they have it is what makes the request worth examining honestly. The first use of your income data is credit limit calibration, and it is more complicated than it appears. The straightforward logic is that higher income justifies higher credit limits. You earn more, you can theoretically handle more credit, the bank extends more. This seems like a neutral or even beneficial outcome. Here is what the logic omits. Banks know from decades of behavioral data that customers tend to use the credit available to them. Not all of it, not recklessly, but the correlation between available credit limit and carried balance is well documented and consistent across income levels. A customer with a $12,000 limit carries a higher average balance than the same customer would carry with a $7,000 limit. The higher limit is not a reward for your income growth. It is an expansion of the environment in which debt accumulation becomes more likely. The bank gives you more credit because customers with more credit generate more interest revenue, not because extending more credit is in your interest. When you update your income upward, the algorithm recalculates your limit ceiling. Your limit increases, your spending capacity expands, the bank's interest revenue potential grows with it. The framing is that this serves you. The mathematics suggest it serves them. The second use of your income data is what banks internally call ability to pay pricing, and this one is worth sitting with. The intuitive assumption is that higher income means lower interest rates. Higher earners are lower risk, the logic goes. So they should receive better terms. This assumption is partially correct and strategically incomplete. Banks use income data not only to assess your risk level, but to assess your price sensitivity, your likelihood of noticing and responding to unfavorable terms. Here is the uncomfortable finding from banking research. Affluent customers frequently receive worse interest rate terms than their creditworthiness would justify because the algorithm correctly predicts they are less likely to shop around, less likely to call and negotiate, and less likely to switch providers over a few percentage points. A customer earning $185,000 is statistically less likely to spend an afternoon comparing shopping credit card rates than a customer earning $62,000 for whom every percentage point translates into meaningful monthly dollars. The bank prices accordingly. Your high income becomes a signal that you can be charged more without losing your business. The algorithm is not punishing your success. It is exploiting your reduced sensitivity to cost. Ability to pay pricing means the more you can afford, the more they charge, not because you represent higher risk, but because you represent lower resistance. Your updated income number is the data point that tells the algorithm how much resistance to expect. The third use is marketing categorization, and this is the one most people feel most clearly, even if they cannot name the cause. The moment your income updates in the system, your marketing profile recategorizes. You move into a different segment. The offers you see, the products pitched in your banking app, the emails that arrive, the calls from relationship managers, all of it recalibrates to your new income bracket. High-income customers receive aggressive pitches for premium cards with substantial annual fees, private banking services, investment products, and personal loan offers framed as wealth management tools. None of this is accidental. Banks maintain detailed models of how much revenue can be extracted from customers at each income level. They know that a customer earning $160,000 is statistically more likely to say yes to a $450 annual fee card than a customer earning $75,000. They know that high-income customers tend to have more financial complexity, which creates more opportunities to sell adjacent services. They know that once a customer has multiple products with an institution, switching costs rise and retention becomes cheaper. Your updated income figure does not sit passively in a database. It activates a sequence of revenue extraction strategies calibrated to your specific earning level. The friendly pop-up that asked you to update your information was the first step in a process you did not know you were entering. The fourth use is the one most people never consider at all: income data as a factor in account management decisions during economic stress. When economic conditions tighten, banks review their portfolios and make algorithmic decisions about which customers to protect and which to shed. Credit limits get reduced without warning. Accounts get closed proactively. Interest rates get adjusted upward on existing balances. These decisions are not made by humans reviewing individual cases. They are made by algorithms processing thousands of data points simultaneously, and income is among the most heavily weighted. Here is where it becomes counterintuitive. A customer with recently updated high income can be treated in two opposite ways by the same algorithm. In some models, high income signals continued repayment capacity, and the account receives preferential treatment. In others, the same high income triggers ability to pay pricing logic. The bank increases rates because the customer can afford it, and the model predicts they will not leave. The outcome depends on internal decisions the customer cannot see and was never consulted about. The customer whose income data is outdated or absent is evaluated primarily on behavioral data, payment history, utilization patterns, account longevity. These are signals of actual financial behavior rather than claimed earning capacity. Behavioral data is harder for a bank to weaponize than stated income because it reflects what you actually do rather than what you claim to earn. Customers with minimal income data in their profiles tend to receive more consistent treatment because they can only be sorted by their behavior, which, if the behavior is good, tends to produce good outcomes. If this is making you look differently at a pop-up you have closed 100 times without thinking, take 2 seconds and hit the like button. It genuinely helps the channel, and I notice every one. Now, the practical framework. Because the goal here is not anxiety about financial institutions. It is intentional decision-making about what information you provide and when. There are situations where income disclosure is legally required and appropriate. Mortgage applications require full income verification under federal qualified mortgage regulations. You will provide pay stubs, tax returns, and employment documentation, and you should, because those regulations protect both borrowers and the broader mortgage market. Auto loans, through many lenders, require income disclosure, with verification standards varying by institution and loan size. These are the situations where disclosure is not optional and where attempting to minimize it would be both legally problematic and counterproductive. Credit card applications request income. But here is what most people do not know. Credit card companies generally cannot and do not verify the income you provide. They have no access to your tax returns without your permission. They cannot see your pay stubs. They are relying on what you tell them, which tells you something important about why they are asking. They want the data for the algorithmic purposes described above, not because verification would improve their lending decisions. This does not mean you should misrepresent your income. Providing false information on a credit application is fraud. It is illegal, and it carries consequences that no temporary benefit justifies. What it means is that you should be thoughtful about what you include and how you characterize variable or multi-source income. The periodic income update requests on existing accounts are entirely voluntary. No legal obligation, no regulatory requirement, no consequence for declining. The pop-up is designed to look mandatory. It is not. Close it. When it reappears in 3 months, and it will close it again, your accounts will function normally. Your credit score will not change. The bank will simply not have the fresh data it wanted, and your profile will be evaluated primarily on your behavioral history, which is exactly what you want if your behavioral history is good. Here's the action plan that applies immediately. This week, audit your relationship with every financial institution where you hold an account. Open each platform and note whether you have updated your income recently. If you have that, information is now in their system and influencing how they treat you. You cannot remove it, but you can stop refreshing it. Close any pending income update requests without responding. This month, pay attention to what changes in your financial environment. Are you receiving more calls from relationship managers than you used to? Are premium product offers appearing with greater frequency in your banking apps? These are signals that your income data is actively working in their systems. They are also signals that declining future update requests will, over time, allow your profile to decay toward more standard treatment as the fresh data becomes stale. Going forward, apply a simple decision framework to every income disclosure request. Is this legally required for the product or service I am applying for? If yes, provide it accurately and completely. If no, if it is a voluntary update on an existing account, ask yourself whether providing the information benefits you specifically, or whether it primarily provides the institution with ammunition for decisions you cannot. C. If you cannot identify a concrete personal benefit, close the pop-up. When you want a specific outcome that requires income disclosure, a credit limit increase you actually need, a rate reduction you are negotiating, a loan application where favorable terms depend on demonstrating income, provide the information intentionally in that context for that purpose. That is income disclosure working for you. The periodic unsolicited update request is income disclosure working for them. That woman who opened her banking app on a Tuesday afternoon to make a simple transfer, she is not unique. The same pop-up appears in millions of accounts with the same friendly font, the same pre-filled field, the same 11-second path to compliance. Most people complete it. Most people have no idea that completing it triggers a reclassification that will quietly adjust every aspect of how that institution treats them for years. The bank did not tell her what would happen. The pop-up did not explain that her updated number would activate a marketing recategorization, a credit limit reassessment, and an interest rate model calibrated to her new income bracket. It just asked her to help them serve her better, and she did. Because the request looked routine, because non-compliance felt awkward, because nobody had ever explained to her that she had a choice. You have a choice. You always had a choice. Financial institutions have simply done an extremely effective job of constructing interactions that make the choice invisible. The next time that pop-up appears, and it will, you will know exactly what it is. You will know what the bank intends to do with the information it is requesting. And you will know that closing it without responding is not non-compliance. It is not suspicious. It is not a problem. It is you deciding that your financial data belongs to you, and that you will share it deliberately when it serves your interests, not reflexively, when it serves theirs. I'm Williams. The pop-up is going to appear again. Now you know what to do with it. If these conversations are giving you something genuinely useful, consider subscribing. I make videos like this every single week, and I try to make every one worth far more than the time it costs to watch. I will see you in the next one.